Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 28th of May. I'm Daniel Lam, your host for the podcast. As markets get more nervous about threats from inflation, investors will be applying extra scrutiny on the data releases. Now, we've long argued that any filtering through of the elevated energy prices to consumer activities would act as a quote-unquote natural counter to inflation. The recently released U.S. consumer confidence softened marginally in May as high oil prices kept inflation pressure in focus. The Conference Board Consumer Confidence Index slipped to 93.1 from an upwardly revised 93.8 in April, but still came in slightly above consensus, with current conditions weakening even as expectations edged higher. The deterioration came primarily on the Present Situation Index, which fell 3.2 points to 121.2 as views on business and employment conditions worsened. The Expectations Index rose 1 point to 74.4 due to improved views on business and labor market conditions 6 months ahead. Household income expectations were slightly less positive, keeping the rebound modest. Spending intentions weakened beneath the surface. Big-ticket purchase plans continue to move from yes to no. Special questions showed 2/3 of consumers are cutting spending because of rising prices, mainly by buying fewer items and delaying expensive purchases. Now, many still plan to make those delayed purchases within 6 months, but the Hormuz Strait crisis is clearly affecting consumer behavior. Where do we go from here? Well, the flows through the Strait of Hormuz is a fraction of the normal traffic. This continues to disrupt the supply side of things. It would take time before the traffic normalizes. Vessels would be hesitant to return, given the risk of getting strained again in the Persian Gulf. Do not forget that resilient economic data under inflationary environment would often be seen as a negative for the markets because it would decrease the probability or push out the timing of any potential Fed rate cuts. Hence, investors should not be going into the markets at full fray at this moment in time. Instead, it is prudent to be averaging into your favorite trades and exercise patience in adding exposure. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.